Accounting equation and Excel, adjusting entry for accrued interest. Get ready and some coffee because we're about to learn the accounting foundation, the accounting equation, using Excel. First, a word from our sponsor. Yeah, actually, we're sponsoring ourselves on this one because apparently the merchandisers, they don't want to be seen with us. But that's okay, whatever. Because our merchandise is better than their stupid stuff anyways. Like our Trust Me, I'm an Accountant product line. Yeah, it's paramount that you let people know that you're an accountant. Because apparently we're among the only ones equipped with the number crunching skills to answer society's current deep, complex, and nuanced questions. If you would like a commercial-free experience, consider subscribing to our website at accountinginstruction.com or accountinginstruction.thinkific.com. In Excel, if you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you could begin back there or just construct your own worksheet as we go, or possibly just follow along with good old paper and pencil. If you do have access to this workbook, though, 5 tabs down below. Example, in essence, the answer key. Month 1, first month of operations. Month 2, second month of operations. Practice tab having pre-formatted cells so you can practice the practice problem with less Excel formatting. Adjusting tab, the one that we will be working in, is where we started with a blank worksheet but are basically working within a template at this time. However, we will be adding to that template as needed as we go, practicing our Excel tools and formatting as we do so. Let's go to the example tab to get an idea of what we will be doing, remembering that we're basically building our bookkeeping system using the accounting equation as, in essence, our trial balance from which we can construct our major financial statements: balance sheet, income statement, statement of equity. So now we're imagining that we're doing the adjusting process. I think it's easiest to imagine in our mind that we're a separate public accounting firm or tax preparer receiving the information from a client, possibly in the format of QuickBooks or Xero, extracting the financial information, possibly from the financial reports, to construct our unadjusted trial balance. In this case, rather than a trial balance format of debits and credits, the accounting equation type format, so that we can use our worksheet to create the adjusting entries that would possibly be needed to get the books as close to whatever accounting basis that we are on, which would typically be the accrual basis. But you might have a similar process for, of course, a tax basis as well if you are in the United States. So that's what we did last time. We extracted the information. We started with the ending balance, what was given to us from the client. And now we're going to be doing our adjusting entries, typically having to do with timing entries, but also having to do with whatever we need in order to make the two objectives of the bookkeeper and the objectives of the CPA firm or external reporting objective separate. Now, remember, you can do this yourself. You might do the same exact process if you were doing both sides. You're doing the bookkeeping and you're doing the tax preparation or external reporting. You would still separate the two items so that you can have the objectives of bookkeeping separate from the objectives of financial statement reporting and tax preparation. All right, so that's what we're going to do this time. Now that we have our worksheet, we're going to do the first adjusting entry for accrued interest. And so that's going to basically be a normal type of adjusting entry. Most adjusting entries, if you look like at a book problem, will have an income statement component to it because the income statement is a timing statement. So a classical adjusting entry might be formally or strictly defined as something that's going to have a timing component to it, typically not including cash. Cash is basically typically good to go because it is what it is, right? Cash is what it is, and we already did the bank reconciliation for it. The problem is when there's a difference between recognition or receiving or paying of cash and recognition of expenses or income on usually an accrual basis, because those two things don't happen at the same time all the time. And that's usually the classical definition of an adjusting entry. But the more expanded definition of adjusting entry will be anything we need to do at the end of the period, including those items that might not have a cash component. An example of that would be when we get to the loans, for example, in terms of short-term and long-term reporting of the loans. It doesn't have an income component to it. It's just 2 balance sheet accounts, but still the objective of it being easier to have 1 account per loan versus 2 accounts per loan would lead to a similar kind of process. All right, so let's go on to the adjusting tab. So what we're going to do is we're going to take this loan first. Now, there's many issues with the loans that we're going to deal with. One is the fact that loan payments have an interest portion and a principal portion. And we've got to somehow break out the interest and principal and make sure at financial statement reporting, we have the proper breakout of interest and principal, recording the proper amount of interest. And then 2, we've got to have the reporting of long-term and short-term for external reporting, which might not be as needed for tax preparation for small sole proprietors, as we're not reporting the balance sheet typically in that case. But still, we would need short-term and long-term reporting. We have an issue of should we be grouping the loans together for external reporting and have separate loans when they're on the books? And then we have an issue with the interest payments, and that's what we want to focus in on here, where we might have accrued interest that has accrued but hasn't been paid. And so that's going to be a classical timing type of situation. To imagine that, let's build our amortization table over here. I'm going to go all the way to the right, and we're going to make a little amortization table. Go all the way to the right, and let's just do it way over here. All right, I'll make a skinny. So I'm going to select the drop down here for the skinny and format paint that to the HB skinny. And I'm just going to make another amortization schedule. It's going to be loan. I'm going to say months. This is going to be the terms of it. Months are going to be, I'm just going to say 3 months. I'm going to say the rate is an incredibly high 35% because it's such a short-term loan, and I want to make it significant so we get the idea of what is happening. And then we have the payment. And the payment, I'll do a calculation for the payment just so we can get an idea of it. Let's say the loan was for $5,000 and the payment, let's do a negative PMT. That's the payment calculation tab. The rate, 35%. That would be a yearly rate, however, and we're doing it in terms of months. So I'm going to divide it by 12, comma. The number of payments is going to be just 3 months. And then comma, the present value is the loan amount. Boom, bam. So the payment's going to be $1,765. All right, so then I'm going to make another skinny. I'll take this skinny, home tab, format paint, put it on the he column, the HE column. So then I'm going to say this is going to be months. Hold on a second here. Maybe I should bring it down one. Let's bring this all down here because this cell's already fat. It's a wide cell. So we'll put it there. Months, and then payments and interest and reduction of, let's say, of balance, let's say. Balance, and then loan balance. I'm going to select these, make them a header format, home tab, font group, making it black, making it white, and let's wrap the text since I have this fat cell here and it should be able to handle that. Let's also center it, and we'll make this one maybe a little wider. Okay, so months, there's just going to be, now I'm going to date these this time. So I'm going to say I need a date format. So I'm going to select this whole column, right click, format the cells, and I'm going to make it a date. And I don't really want the year, so I'm just going to say this one. Give me the month and the day to make it generic problem. And so I'm going to say on 2/15, and then 3/15, 4/15, and 5/15 we make the payments. The payment, so the loan amount is going to be 5,000. And we've did this amortization before on the long loan, so I'm going to do this a little bit faster here. So we have the payment. The payments are always going to be 1,765. Those remain the same. That's going to be the same all the way down. The interest is going to be 5,000 times the 35%, but that would be for a year. I want a month, so we're going to say divided by 12, and that's going to give us 146. That means the reduction to the loan is going to be 1,765. Mine is 146. And then the loan balance after that first payment is going to be the 5,000 minus the loan reduction, not including the interest. The interest is the rent on the loan. It just goes away. Now, if I copy this down, I have to be careful of this cell that's in my data, and it's not over here in the table because it's not going to move down relative. Therefore, this cell H5, which is right here, I'm going to select that and say F4, putting a $sign before the letter and number, making it absolute, telling Excel, don't move that down when I copy it down. So we're going to say, okay, and then I'll select these, and we'll just grab that fill handle and drag it on down. And so now you can see it goes down to 0 down here. That's a good indication that we've got this correct. Now, the issue I want to talk about with this particular loan, we're going to imagine that we took the loan out on 2/15. And remember, our cutoff date is 2/28. So as of 2/28, I should be recording all of the interest that has been incurred. In a similar way, if I rented like an apartment building or if I rented like an office building, if I hadn't paid the rent, but I've been working out of the office building and I owe the rent, then I should record it as a liability when I create the financial statements. Similarly with interest. Now here, because I made an installment loan, that's like the most common kind of loan. We're not going to have a big difference because of the size of the loan and because it's monthly installments. But when you talk about business loans, it's not always an installment loan. You can imagine other structures for a business loan. A business loan might say, well, I'm going to give you 5,000. I'm going to give you 5,000 on 2/15, and you don't have to pay any of it back. You pay the interest and principal back, I don't know, in 5 years or something. You can imagine a loan like that, in which case you're not going to have the actual payments on a monthly basis, which kind of force us to adjust the loan to the proper amount if we're using the amortization table, right? What would happen is we wouldn't record anything on a cash basis because nothing's going to clear the bank until we pay the loan back in 5 years or whatever, right? So, but I want to structure it this way just so we get because I think most people are used to loans that have installment payments. Even then, you still have a kind of an issue because you can see that the payments are being made on the middle of each month. So as of the end of our period, there's been, almost 15 days, right? We're going to say half a month, even though it's in February and there's only 28 days or whatever, 29 depending. But we're going to say, but we didn't pay it until 3/15. So this interest that we paid right here is really covering two months, right? Half of last month, half of this month, and the second half of this really belongs in the next month, right? So if I was to get perfect on this, what I'd like to do is before the cutoff date is take that 146 divided by 2. That $73 should be accrued interest, similar to if I was using like an office building, but I hadn't paid the rent yet. I should record the fact that I owe the rent. Now, notice there's a difference here because I'm not going to say I'm owing the rent because I signed a contract and therefore I have to pay the rent according to the contract. That doesn't mean we put something on the books as a liability because although we're forced to pay it in the future, we haven't yet consumed it. So in other words, when I sign a contract for like a rental office, I might sign a contract for a year and I'll have to owe a year $12,000, let's say, for the year. I'm not going to put a liability on the books for $12,000, even though I'm committed to doing that. And I can't really get out of the contract because I haven't really consumed it. The only way I could get out of the contract is if they kicked me out of the building, then obviously I wouldn't have to pay because they violated the contract, right? But if I actually used the building, then I should be recording the rent, the fact that I have to pay it, whether I actually paid it or not, right? Let's say they're not going to force us to pay the $12,000 until the end of the year for whatever reason. So then as I use the building, that's when I incurred the rent. Similarly here, as I used the money as time passes, we used the purchasing power of the $5,000. That's when I should be recording the interest. And as of the cutoff date, I used half a month of interest. So technically I should be reporting this. Now you might say, well, $73, that's kind of ridiculous. Kind of is. You don't really need to do maybe $73. Why? Because it would be immaterial and therefore it's not going to have a big impact on decision-making processes, but the concept remains. If it was a larger dollar amount, it could certainly be material, in which case you would want to basically record it. If this loan was, $500,000, then it's going to be starting to be significant possibly. And again, you can imagine contracts where they're not on installment payments so that you're basically you don't pay every month, right? You might be paying, again, balloon payment at the end of the loan, in which case this number will become quite significant because the interest will be accruing and you're never going to end up paying it until the balloon payment or the full amount of the loan is due. So keep that in mind, like just conceptually. So you might say, again, this is too small of a dollar amount to deal with, but conceptually, you can imagine if it was a larger dollar amount, it would be significant for those reasons. All right, that's the idea. So I'm going to make this blue and bordered. So blue and bordered, and then border blue and border blue. And then let's go all the way back to the left. And so we're going to say that then we have on 228. Now, all of my adjusting entries are always going to be as of the end of the period, which usually we would think like at the end of the year or at the end of each month. But it's at the, because that's when the cutoff period is important to us, because we're reporting the financial statements as of that point in time. So we're sacrificing the fact that I wasn't on a perfect accrual basis on 227. If you run the financial statements as of 227, it's not going to be perfectly on an accrual basis or as close as we can get it, because we're going to sacrifice that and say we're going to make the adjustments as of 228 so that all my adjustments are as of the same date, so that I can identify the adjusting entries versus the other transactions, and so that we can make the financial statements correct when we actually give the external reports. So that means, so again, you might be saying, well, what I should be doing is making a transaction for every day of the 15 or whatever days in that are still before, so that I can make the financial statements correct each day. No, that would be quite tedious, right? That's the point. It's a trade-off to make things efficient versus correct as of the cutoff date. So these are going to be for accrued. So let's say ADJ, accrued interest. Now, we might do this like in an external, in like a CPA firm. Actually, in Excel, I would actually do this in Excel. I don't think there's a better software, although a lot of people might argue with that. Maybe I'm old school or whatever, but I still think Excel is the best thing to do adjusting entries with personally. But, anyways, but we might, after we do the adjusting entries, then enter it into the QuickBooks system or into the Xero system. And again, I like doing it externally so I can see everything on the two-dimensional screen rather than in the database program where much of the actual transactions are hidden. You can't see the worksheet. So the point is, with the adjusting entries, there shouldn't be too many of them. And if I post them to a trial balance instead of to the general ledger that then creates the financial statements, it's more transparent. I can see what is happening. But when we actually do put it into the QuickBooks software or into Xero or something, notice that it's not going to use an actual form. We're not going to be using like an invoice or a sales receipt form or so on and so forth. It's actually going to be the form. They still call it a form, but it's a journal entry form, which means it's just going to be debits and credits. And that will help us to differentiate the adjusting entries, which should all be journal entries, not forms, not deposit forms, not expense forms. And we can also basically put a note on the transaction that it is an adjusting entry. That's important because, again, we want to draw a line between what the bookkeeping process is doing, no matter who's doing it, us or the bookkeeper, and what the adjusting process is doing. And we do that by using the journal entry form instead of other types of forms. And we can use, again, a note that says this is an adjusting entry. Okay, so let's just say this equals, then I'll pick up the amount over here. I'm going to just say equals and scroll all the way to the right, picking up the amount of the $73. All right, so then where's that going to go? So remember, on the adjusting entries, cash is typically not affected, and usually you have one balance sheet account and one income statement account. What's going to be the balance sheet account? It should be something that's going to be related to the loan payment. And so you might say, well, I should record it to the loan payable account here. This loan payable 1 and 2. But we don't want to put it into the loan payable because it's not really the loan principal that is due. It's the accrued interest. It's the rent on the principal that is due. It would be similar to saying we owe the bank this amount, but if we take the analogy of renting an office building, I'm going to give back the office building at the end, right? So I should be recording if there's accrued rent. I'm not going to put it in as rent. I'm going to say it's going to be accrued rent, right? Similarly here, I'm going to give back the loan, right? So the loan is going to be paid back, and I'm going to record the interest separately because it's not the principal of the loan. This is accrued interest on the loan. So to do that, I'm going to select the drop down here. I'm going to right click and insert. Now, you could also have a question of, should I have a separate accrued interest? I'm going to call it interest payable, by the way, because I think that's just easier to put in. It shows in my mind that it's a liability. Payable typically means liability to me, but I think the more formal language would be accrued interest. Why do they call it that? Because the interest has been accrued and not paid. It's going up and you haven't paid it down yet. The liability is going up and hasn't been paid down. You could have a separate accrued interest per loan, and that might make it a little bit easier from a bookkeeping standpoint. However, normally I would make just one accrued interest account, which is what you would normally do for external reporting as well, and then have the subledgers helping us to determine, as well as the adjusting entries and the notes to the adjusting entries, what happened with the accrued interest. So I'm going to say this equals the 73. Now the other side is going to go to interest expense. Interest expense, we put way over here. It's going to be like a normal expense. The expense is going up, I would say, bringing the net income down, meaning, and that brings equity down. So I'm going to put it in here as a negative because it's going to be decreasing equity, and our focus is equity, but really the expense is going up, bringing down net income, which brings down equity. So let's put the zeros across the board. Zeros across the board. Oh, not there. Not there. Okay, now Control Z. Zeros across the board except for that one. Zeros across the board. Zeros across the board. All right, let's underline. I'm holding down Shift, selecting the whole thing. And we'll go Home tab, Font Group, Underline. And then I'll go all the way to the left. Let's pull down the balance to see if we remain in balance. I'm going to pull it down 2 because I'm going to put the sum. So there it is, liabilities. Liabilities went up and equity went down. Classic adjusting entry, because there's a balance sheet component and an income statement component that's in the equity section, or that's part of equity. It's the income statement. Then I'm going to bring down the balance. So the balance is going to be equal to the sum of the prior balance plus the current activity. We'll copy that, and then holding down shift all the way to the right, and we will right click and paste just the formulae, and then I'll bring down the signs. Bring down the signs for formatting's sake. Okay, so there we have it. So that looks good. We're in balance. That looks good. And so what happened is our liabilities went up and our expenses went up. Now, this is kind of an issue, by the way. If you do adjusting entries, then oftentimes most of the adjusting entries tend to make the business look worse, right? And just be aware of this. If you're in public accounting, you're always going to have this tension from your clients, because the clients obviously have an incentive to want to look bad for taxes. So just keep this in your mind. They want you to look. Why? Because you don't want income. You don't go to the king, to the government bureaucracy, bragging about how much money you have, right? Because then they take it, right? so you try to go there with holes in your jeans. You're like, I don't know, I don't have any. Take it easy on me, man. I ain't got nothing. But on the other hand, if you're trying to grow your business, then you might try to be enticing investors, in which case you want to usually look good. You're like, look, I've been doing great. The business is on the way up, man. You want to be on the train here. Or if you're trying to get a loan, which is similar to that same thing, you're trying to tell the bank, hey, look, I'm a sure thing. I'm going to pay the loan back. We're growing like crazy. We're looking good. So in that case, the business is going to want to look good. So it really depends. And for us on the public accounting side, we're just trying to do what's right with regards to whatever the format is that we have to record things. If it's a tax basis, we're going to just follow the rules on the tax basis as best we can. And if it's an accrual basis for external reporting, then we're going to follow the rules as best we can. But just realize that those are going to be the push and pulls. Clients are going to sometimes want to look good for getting a loan and for trying to get investors, and then they're going to want to look bad for taxes, which of course you can't do both at the same time typically. I mean, that's not so that's going to be the tension. A lot of the adjusting entries usually that deal with expenses make us look worse oftentimes, right? Because the adjusting entries, as you can see here, is bringing our net income down. So our net income before was this 4770, and now the net income is going down to 4687. Now, the biggest one that does that is usually depreciation, right? That's the one they don't take into account, because a lot of owners of businesses are on a cash flow basis. They're thinking about how much money they have because they're trying to invest that money in equipment to generate revenue and so on and so forth. So they often, if you're in those types of industries, which I've been in with like construction companies that have a lot of equipment, then they often are a little bit shocked that their income statement looked really good until you recorded depreciation expense. And they're like, why did you do that? I already paid for that equipment in the past. And it's like, well, that's the accrual method we have. So that makes the net income look worse, right? So that's often one of the big ones. Now, there are going to be some items which will make net income go up, which we'll talk about as well. But depreciation is often a big one. All right, so that's going to be that one.